So today we've been talking a lot about investing committees, divestment, how a lot of these issues work. And at our table before, Dorian and I were sitting, and someone turned to us and asked us, okay, but what about investing in the solutions? We were like, just wait a half an hour. We're getting there. So we're at that part of the day today. If you look in your journal, you'll see that we've got the bios for our speakers. We also have Steve Wong from the Working World who's joining us too. So he unfortunately isn't in there, but we're lucky to have him on the panel. We're each going to spend a few minutes talking about our firms and what they do and what they offer to help you invest in solutions. I'm going to kick off for a few minutes and talk about the work that I do. I'm head of North America for the Principles of Responsible Investment. We are an investor network. We have 1,200 signatories from the investor world. They represent about $45 trillion. And each and every one of these players in the investment field has committed to 6 principles that guide how they invest. And these 6 principles are all based on looking at environmental, social, and governance factors. I'm not going to go through all of them because they're a little bit dry, to be quite honest. But they look at how do you taking environmental, social considerations into a factor when you invest as an active owner, so shareholder engagement, which we've been talking about, public policy, also collaborating with your peers. A lot of times when I start talking to people about the work that I do, there's often a concern that looking at these factors will mean that you'll lose money. PRI believes that addressing these factors is actually beneficial for you over a long-term horizon. And to that point, we have a number of pension funds that are part of the PRI. And if you think about, we've talked a little bit about fiduciary duty. Fiduciary duty frameworks for pension funds is incredibly stringent, to the point that they can actually be sued if they're seen as going beyond them. So I think seeing that there are leaders globally from the pension fund community, and given the restrictions that they have, should give you guys all an idea of the fact that this is possible. It is possible for your organization to do it, and it just really has a lot to do with kind of the approach. And one other thing I just want to bring up, when you look at a lot of business risks that are out there and that we're seeing more and more in the news, they're often tied to environmental and social issues. If you look at human rights risks and supply chains, we hear a lot about the risk side and the downside. We don't hear that much about the opportunity side. So that's a lot of what we're going to chat about today. And in terms of the role that endowments can play, we have 2 major endowment members, University of California and Harvard, both signed on in the past year as part of their commitment to looking at these issues. And they both, if you look at their approach, are also having a solutions-based approach to how they're going to be addressing climate change. With that kicked off, I'm actually going to start asking some of the panelists questions. Give me 1 second here. So Dorian, it would be great if you could talk a little bit about what the CFNE is and what a CDFI is. I know for some people from the investment community it might be a familiar term, but I think it would be helpful for our audience to understand what you do and also how your approach and CDFIs can fit into an asset allocation model.
Sure, thank you, Sonal. CFNE is the Cooperative Fund of New England. We are a CDFI, a community development financial institution, specifically a community development loan fund. Community development loan funds, along with community development banks, community development credit unions, community development venture capital funds, all these different financial institutions, CDFIs, started back in the mid-90s based on some legislation, and they're effectively certified by the US Treasury, and as a result are available to receive government funds, but also rely on invested funds. Individuals and institutions invest in the loan fund, and the loan funds then make loans to the community. We're mission-driven to develop the community, and we're focused in a number of areas, but primarily decent jobs, affordable housing, sustainable food systems, and access to healthy food. And in our case, the Cooperative Fund of New England, we pay attention to ownership matters. We make loans to cooperatives that are member-owned, community-owned, worker-owned, democratically owned and democratically managed endeavors and enterprises. So some of them that you may have heard of, here in the Pioneer Valley, we've made loans to River Valley Market Food Co-op. We make loans to some of the manufactured housing communities so that the residents in those communities can own the land, and that helps to keep things affordable for them. We've made loans to a lot of the local businesses that are worker cooperatives. You're familiar with Collective Copies and some of the others in the area. So there are many different types of CDFIs throughout the country, but here I'm representing the Cooperative Fund of New England, and we are a regional lender. When organizations or individuals invest in the fund, they earn a return that is anywhere from 0 to 2%. Not very high, a low return, but also incredibly low risk. In 40 years, no investor has ever lost money in our fund. So there's a place for us in every portfolio, that place where you want certain funds to remain stable and predictable and relatively secure.
Great, thank you for that. Lynn, moving on to you. What is Co-op Power and how would a college or university invest?
Great. So Co-op Power is a energy cooperative. We're a multi-class, a multi-race cooperative that really looks at all of us as customers, consumers, all of us as workers, putting either volunteer time in or work time in, and all of us as investors. And we work to create opportunities to become fossil fuel free. And when we started 10 years ago, there weren't a lot of ways people could get fossil fuel free, but over the last 10 years, we've invested a huge amount of time and money in building out the infrastructure so that now we're launching our campaign for all of our members and supporters. We've got about 7,000 people in our network to become fossil fuel free. And whether they're low-income folks or people with a lot of wealth, we're sharing resources to make that all happen. And with energy efficiency and renewable energy efforts, also business development and job development work. And in the past 10 years, I've got some stats I can just tell you, and then I'll answer your question about colleges. We've created 12 businesses that have about $15 million in annual revenue now, 200 jobs. We have 475 families that own us across Massachusetts, a little bit in southern Vermont, and a little bit in Rhode Island. We've raised $300,000 in member equity. We've raised $1.3 million in member loans. We've raised $1.4 million in grants. We've raised $860,000 in a private placement, $200,000 from community loan funds, and we're in the process now of launching our biodiesel plant. We're raising $1.8 million more for that, and looks like $250,000 will come from local loan funds. I'm telling you all this because in order to create community initiatives, local initiatives, you need to be able to raise cash, and it comes from a lot of different places. And we're also launching our community shared solar program, and we have a group that's interested in providing $6 million worth of tax equity for the 5 megawatts of community solar projects that we're putting together. We're also raising loan money, and we're hoping that all of the people, the 2,000 people that get their electricity from this community solar, are going to put in about $4,500 each, which will raise the other half the money we need. And they'll be prepaying for 25 years of electricity at half price. So we think, and we've got loans, discount loan funds for people to be able to get a hold of that. So we're like rocking and rolling, but a lot of what we do is finance. And we've also talked to colleges about how they might invest. So before I go to that, all of you are investors, even if you're in college. You know, you're investing your time, you're investing your career, you're investing, you know, you're right now looking ahead at what you can do to make the world the kind of place you want to leave for your children and their children and their children. And becoming fossil fuel free, really addressing climate change, means that you're going to be carefully thinking about those investments that you're making, which are equivalent to anything you're asking your college or university to do. So I want you to take those investments as seriously as you are this work of getting your college and university to invest in the right things. And in order for colleges and universities to invest directly in any local project like ours, there's a gap. There's a gap because what we do is high risk, and endowments aren't a good match for that. So you'd have to have folks who are part of that university that were willing to do direct due diligence to be able to bring recommendations back to their universities and colleges. You'd have to have the college be willing to set aside a very small portion of their endowment for high-risk investments, for venture capital type investment. And it might be something that a group of colleges might do together, is to work either through a CDFI like Co-op Fund of New England or another community development loan fund, where you do that due diligence together and figure out how you can support initiatives like this, because initiatives like Co-op Power are happening all across the country, and they really need the kind of support from colleges and universities that have that values investing lens. And the more we can get local money into local markets to change the way our local economies are working, the more effective they're going to be. So I hope that you guys are on the cutting edge of helping to move those investing policies to include groups like Co-op Power.
Thank you, Lynn. And Steve, can you tell us about your firm and where you guys are in the solution-based world?
I work for The Working World. We're a nonprofit investment fund that supports worker-owned companies. We provide both investment capital and technical assistance, training, business development to worker-owned companies. We're an international organization. We've been in Argentina, Nicaragua, and we just opened an office in New York about 2 years ago. We've been around for 10 years altogether. We've invested about $4 million in the last 10 years. And this year and the next coming years, we're gearing up to have a multi-million-dollar fund, evergreen loan fund for worker-owned companies. We're a little bit different than what other investment funds do for a couple different reasons. The first one is primarily that we represent the interests of the community and the projects that we work with, rather than the investors primarily. What I mean by that is we look to maximize the wealth that we're creating, the impact that we have for the projects and the people we work with, and then provide a fixed, smaller 0.3% return for our investors primarily. One big example you might know is we work with New Era Windows. It's a big Windows factory in Chicago. It went bankrupt because it wasn't providing enough profit for the investors, but the workers bought it out, and they've been growing the business. And between the money that the factory's creating, it's creating a lot of value for the community in Chicago. The second main reason that we're different is that we invest in worker-owned companies, community-owned companies. We believe it builds wealth and assets for the people we work with, galvanizes leadership in these communities. We also believe it's a really successful investment model because when we let the people we work with reap the rewards of the investments, we really find that we have a lot more success. We lower our risk. They're really able to take advantage of they see the prize at the end, and that it really changes the investment equation. It kind of gets the support of the institution of the business, which is a challenging question in the investment field. And the third way is tied to the first. The third way we're different ties to the first. It's about representing the interests of the people we work with rather than the investors. And that basically means that all our investments are non-extractive. So basically when we started the firm, we decided we wouldn't leave any of the people we work with worse off than when we started. We wouldn't leave anyone in debt. So basically, our projects are only repaid with profits from the investments themselves. That process basically means we do a lot of planning, a lot of training, a lot of hands-on assistance with the businesses we work with to make sure that those projects can be successful.
Great, thank you. And Charles, we'll move on to you. Before I ask you directly about what your firm does, can you first explain what bonds are and what fixed income is? And then it would be great to have you talk about what green bonds are and how they fit into the space.
Thank you very much. That's a great introduction. We're sitting on opposite sides of the room, I think, because they're doing the really cool stuff and I'm doing the really boring stuff. But when you get to it, and can I have the next slide, please? Think about what equity is about, stocks, and what bonds are about, loans. And the little graphics at the bottom show a hammer and a saw in case you're in the back of the room. They're both very, very useful construction tools, but if you try to use one to do the job of the other, you're not going to get very far. The point is that you need both kinds of investments to build a successful endowment. The purpose of stock is to make money by the value of the stocks, the companies that you own, growing over a period of time. Dividends, interest, or income from the stocks is a secondary consideration. You have the opportunity for fairly high returns. On average, over the last 90 years, it's been pushing 10%, but wild swings up and down, as much as 45% up, 45% down in any given year. So that's the high risk, high reward structure that you look at in the stock world. On the other side is the bond world, and the purpose of that is interest income. They're not built for growth, they're just not built for them, because the value of them is always going to end up being face value when they mature. So you get modest returns. In a good year, you get 5%. In a mediocre year, you lose 2, maybe 3, but you have a lot of stability. And what's interesting is when you're building an overall portfolio or an endowment, having both kinds of investments in that allows you to have less fluctuation in the value of your total endowment. In many cases, but not all, the news that raises the price of stocks depresses the price of bonds. And that has to do with economic forces and vice versa. But having the two in there reduces the up and down movement in the value of the endowment. And if you have an endowment on which you are taking 5% a year, and I think Liz touched on that in the last panel, it's important to have a certain amount of predictability in the value of your assets. So that's why we talk about bonds in here. They're not nearly as much fun, there's not really as much upside, but there's an awful lot of good reason to have them in there. It's like building a basement. Boring part of the house, but you gotta have one. Let me jump to the next part of the presentation, which is on green bonds. Oh, it's there. Cool. Green bonds sound like a great big new innovation, and what it is they're a great big new label. This is something that's been around for a while. The idea is that if you identify the purpose for which you are issuing a bond, and you commit in your bond documents to use the money for specific green purposes, and you get it certified and you get it reviewed and periodically valued, you can put a green bond label on your investment. Why do you want to do that? The original demand came from the Scandinavian government investment pools that needed that had SRI mandates, responsible investment mandates, and green mandates. And it was fairly clear to see what the stock choices were, but it wasn't clear what the bond choices were. So the Scandinavian governments teamed up with the World Bank and with a research arm of the University of Oslo to create definitions and certification of green bonds. The first one came out in 2009. There was almost no issuance that year. Last year, $20 billion was raised in that market. That's great. It's nowhere near scale, but it's great. What do they finance? Predominantly wind and solar energy, mass transit, clean water, climate resilience. Most of it's done overseas, most of it in Europe, because that's where the big demand is. It's coming in the United States. Like I said, the World Bank and some of the European development corporations and government type funds are the biggest issuers, but you're beginning to see a few here. Can I have the next slide, please? U.S. corporate issuers include people like Toyota Finance, which did a really interesting deal. They borrowed money to make loans for the purchase of hybrid and electric vehicles. Solar City did residential finance program to put solar panels on roofs. Bank of America issued a green bond for various initiatives in its building, and NRG, that should say NRG Yield, issued a bond to build a big solar farm in the Southern California desert. You'll see green real estate financed through some Fannie Mae backed mortgages, and you'll see that in a lot of the green bond funds. I think Cheryl buys some of those, and that's been a very, very exciting and very productive way of putting capital to great use. You asked about what's been doing in the municipal market. I'll talk about it, although endowments generally don't buy municipal bonds because since they are tax exempt, they don't need tax exempt income. Here in Massachusetts, we were the first state to label some of our bonds green. This was done in late 2013, second issue last year. California has followed suit. Iowa just issued green bonds for clean water. We're seeing a lot of bonds that are green by definition, but without the label. So if you can think of them as kind of generic green bonds, that's cool too. In the university space, Massachusetts Institute of Technology refinanced a big green LEED project and issued green bonds for that. University of Cincinnati did the same thing to rebuild a large student apartment complex and bring it up to LEED. And the University of Massachusetts issued green bonds for a specific portfolio of green projects. I just didn't get a chance to get the details on that, sorry. Briefly, what I do now is I work for a firm called Shelton Capital Management. They brought me in to manage individual portfolios and bonds. I do it mostly for individuals, a couple of institutions, and I've been able to buy and invest in green bonds for my clients based on their investment policies. Some of them are more social investors, some of them are more green investors, some are simply interested in undifferentiated individual bond portfolios. This is a follow-on to the work I've been doing to try to integrate green investing into fixed income, which I actually tried to do it for the first time 25 years ago. It took a while to get it going, but it started. I joined this firm 6 weeks ago. So I'm the new guy and the old guy. It's kind of cool. A couple of other things I wanted to touch on. For the university endowment that is looking for affirmative choices, and that was a wonderful phrase used in an earlier panel, I think green bonds are a great way to go because you've got the definition there. You don't have an argument about what is appropriate and what is not appropriate. You also have, and this has been really interesting and surprising, no material difference in return or yield between labeled green bonds and the larger undifferentiated universe. And these are not my numbers, I got them from Merrill Lynch, who probably has some stake in it, but not an awful lot. The point is you can buy green investments in fixed income. And I've got to say that in the areas that we're represented over here, investing in a CDFI like Dorian's, or investing in indirectly through Workers' World or Co-op Power, you can invest in a green future through fixed income. And that's what I've been doing in this area, and I think I'm going to be using your time better if I answer questions. So thank you.
Well, actually, Charles, I had a quick question for you. Do you mind talking for a little bit about the role, you mentioned capital, and how this is capital, the role of capital for people that don't understand from an economic point of view what that is and why that's important when you're looking at a solution like this, and why for some of these programs, what that difference is than versus somebody just buying a stock in them. Is
I'm going to ask the question, answer the question I think I heard using Steve's example of the window company. There was a company that made windows in Chicago, and they went bust because the shareholders weren't making enough money out of it. The workers got together and with Workers' World help created a new company to buy the old factory and to start producing windows and to do it in a way that would provide them with a living, make a profit. They needed money to do this. None of these people who were factory workers were able to write a $20,000 or $100,000 check to invest in the company. So raising capital from people other than just the owners is a very important way to bring money into a socially useful project. How many of you eat Equal Exchange chocolate or drink Equal Exchange coffee? Okay, that is a co-op, and it is worker owned, and they raise additional money by selling preferred stock. That is another strategy. There are any number of companies that do that. I think that there is a role, probably small and probably in what's called the economically targeted investment space, for this kind of investment within an endowment. This is a question that gets to investment policy. It's a sticky one. It ought to be resolved way before you start talking about specifics. Does that answer your question?
I was just going to add, for when the capital is tied to a green bond, for some of these corporations, it means that it is funding that is going to go towards a sustainability issue that they want to address. A lot of times corporations internally have a high internal rate of return that a project needs to meet. If they can get the capital at a lower cost externally, that allows certain projects to go forward. So that's where green bonds and this external capital can kind of play a role.